Why is it that most people work their entire life chasing money but never truly understand it? We talk a lot about investments, savings, and side hustles, but no one truly talks about how to have a healthy relationship with your money. Joining us today, we have someone truly special. He has been around the industry for over 20 years. He has studied various portfolios, understood the market trends, and has helped people make smarter decisions with their money. And now he's creating something truly impactful and meaningful. He's a founder and CEO of Fydaa. So, welcome to the podcast, Kuntal. My first question would be about you. How did your journey begin in finance and in the world of finance? Like, what were the baby steps and what was the first initial steps? And how has the experience been so far?
So my journey started in finance way back. I mean, even before I graduated. So I think from class 12th standard, I was very fascinated by stock market and all because I was exposed to a lot of these IPO filings from my father, and so that's how my first interaction with the market in general started off. And then there was no looking back. I never thought about any other career other than finance to pursue after that. So most of my further career choices were more to do with getting into the right colleges, which can get me into the markets. And that's how I did my MBA Finance from Symbiosis Pune way back in 2003. The idea was essentially to get into a research job. And that's how my first job, I got landed in a brokerage company. And that's how the journey started as an equity research analyst. Then I was briefly a fund manager with Reliance Capital PMS. And so after roughly 6 to 7 years of work experience, I started my own journey. And predominantly, we were advising corporates. We were advising a lot of HNIs on managing money and funds. And that's what we did for next 10, 15 years in my personal capacity. And then came the tech, fintech as a world where I got exposed to. And gradually I realized that with the use of tech, we can democratize the same quality of advice which we provide to, say, in a Chennai or a corporate. Why not a common man can have the same quality of advice? So with that in mind, in last couple of years, we started Fydaa, which is a completely tech-enabled advisory solution for common man. So it has been a very fulfilling journey from that perspective.
So, apart from being like a really serious finance guy, what is Kuntal Bhansali other than that?
So my hobbies are in general, obviously reading books used to be my very great hobby at some point.
Any recommendations or suggestions?
So most of my recommendation would be around investing. So I would not like to bore your people around here. Everybody knows Warren Buffett. Everybody knows the value of long-term, investing. So reading does help in many ways to build your a research kind of a mindset if you read quite a bit, and that's very essential for anybody who is into research. Other than read, I would say book as a hobby. Traveling is a little bit. I do travel, which is another hobby, but then my real hobby's always been the markets.
Okay.
And even when I'm not free, most of the time I would probably research markets. I'll both India and globally. So I would say that's what that makes sense.
I mean, that's totally great. So yeah, I'm just curious because as a founder, you were trying to bridge in a gap in the market, which I'm sure the existing product or any service was not trying to fulfill. What were you as a founder with the vision trying to solve and bring into the people?
Okay, so this is an interesting question. I mean, the Fydaa started, the word Fydaa, as you all understand, it means benefit. It doesn't mean profit. A lot of people mistake it with profit. And why benefit? Why not profit? The benefit of a quality investment advice is something which is really missing in our ecosystem. My journey for Fydaa, I would say the vision started with my interaction with a lot of common man, especially our drivers, our mates, I keep interacting with a lot of people whom I meet. And I see a common theme there that most of these people are not aware of channelizing their savings into right
Hmm.
products or services. Most of their monies are blocked into either into real estate, gold, or FDRD. And when they need money, despite having a net worth, they have to take loans because the money is blocked into illiquid assets. And that's where I could see that these people need quality advice. They need access to a quality advisor. And when I talk about quality, how to define a quality? And that's where when we decided to be CD registered investment advisor, because there are a lot of people in the market who are self-proclaimed advisors with no regulations applying to them. We consciously decided that we'll go for a SEBI registered license, knowing very well that it will also put us into a lot of restriction as far as our revenue streams are concerned.
Right.
We won't be able to distribute commission products. We won't be able to do a lot of. We have to forego a lot of revenue channels. But then, with the broader vision we had, that we needed a completely conflict-free piece of advice for our users, and that's how this journey started. And the confidence came from my experience in the advising into the fintech sector. I was never a tech person, but I got a lot of insights and a lot of knowledge about tech while advising a lot of fintechs. And that's where I thought, let's marry the finance domain knowledge with the tech, and that will help us probably reach to the masses which we want to reach, and to make that impact which we want to make.
So yeah, like that explains a lot about the tagline that you guys have, which is wealth is for everyone. Being a SEBI registered firm, how does that differentiate you guys from the others in the market?
Okay, so I think being a registered entity gives a lot of credentials and credibility in the eyes of people around. Okay, because having on the right side of the law is the first thing in finance. Okay, if that is a basic bare minimum one needs to have. And when we go and talk to our customers and our clients, we don't have to sell ourselves, because
it speaks for itself.
It speaks for itself. We are registered, so generally people will just take us on the face value. Obviously, they will take our advice. They will judge based on our advice what we are giving to them. But registration is must to filter out people in the industry. And with a lot of people will say that there are very few registered investment advisors in India, and very few people are trying to be making it large in this field. But I think gradually, I would see that the space will open up for a lot many investment advisors, because that's how you can really win the confidence of the common man.
So what's the difference between an advice from a regular advisor and a SEBI registered advisor?
I think the key difference is the conflict of interest. So when you take an advice from a registered entity, they are very transparent about what they are going to charge you as a fee.
Right.
While the non-registered entities will never tell you what is going to be their income from this particular product or service which they are going to offer you. It might sound to you that the advice is coming to you free, but that's not the case. I mean, there's always a hidden cost of expense ratios.
Yeah, a fee or something.
Or a commission or brokerage involved in whatever somebody is advising. So I think that's the fundamental issue with the whole financial service industry. And I think that is taken away when you are dealing with a registered entity. You can be rest assured that the focus is on quality of advice and not on selling a product.
So coming back to the tagline, wealth is for everyone. What is the message that you want to bring across to the people? If you see in India, 63% of the people have less than 5% of the wealth. Okay. While the balance is with the 95% of the wealth is with concentrated. Yeah. Now the reason why the wealth is not generated, it's not that the people's income have not risen in last 20 years or 30 years. Everybody's income have multiplied, whether you go from lower level to middle class and upper middle class. The difference between the wealthy and non-wealthy is how you deploy your surplus savings. The wealthy people always have an access to a quality investment advisor. So their money, their surplus money is managed very well, which multiplies because they are put into into assets which are
which gives returns more than the inflation. And
Right.
that's how the wealth multiplies.
Hmm.
While a common man is generally their wealth is multiplied by 6 to 7% because they put their money into FD, RD, and gold,
Hmm.
okay, and real estates. And that's where the wealth is getting blocked. They're not able to generate wealth even though they have savings. And that's why we thought, how to make wealth for everyone. Okay. Wealth is a process. Somebody has to go through the process. Income is one thing,
Hmm.
but to go through the process of wealth generation, one needs a quality investment advisor on their side
Hmm.
who can, in a conflict-free way, guide them through the different aspect of their life, financial aspect of their life,
Okay.
whether achieving different goals of their lives, whether it's retirement, children education, whether it is, any other dreams, which financial dreams they have. So when you are able to do that, wealth, you will be able to come to a situation where wealth can be generated.
Yeah, so like you were mentioning that how a common man has no access to a good registered advisor or something. So let's say if there's a person who earns like 50,000 a month as a salary, and that person dreams of buying a house in the next 10 years. And what would be like a budgeting scheme for him, or how would that person invest through Fydaa or something?
It's again, as I mentioned, that I just don't want to give a blind answer to it.
Yeah, I mean, there could be multiple factors.
Correct. So,
Hmm.
investment advice is a process. We generally call it financial planning in our parlance. That's how we call it.
Yeah.
So, whether you have any dreams, whether it's a home, whether it's a retirement,
Hmm.
how you can achieve within your income levels. It's not about one income level of 50,000. Somebody might have an income level of 10,000. Somebody might have an income level of 200,000 rupees.
Right.
What process you follow to achieve at your regular income,
Hmm.
and then how you can put that regular income into a regular savings into some kind of regular investment with the help of an investment advisor. I think if somebody follows that process, that is very important. See, the since you asked this question, there is a good point which can be raised here about the SIPs.
Hmm.
There's a lot of chat goes around about SIPs. A lot of people do SIPs, but very few people achieve a dream out of that SIP.
Hmm.
Most of the SIPs are done just to make few good returns over a period of, say, 3 year, 4 year, 5 year, but they don't have an objective.
Hmm.
And that's where the role of an investment advisor comes.
Right.
When you do an SIP with an objective in your mind and which can be tracked and where you can be guided by the investment advisor. Because otherwise, without guidance, most of the people generally redeem their SIPs in less than 3 years' time.
Hmm.
And that's why wealth is never generated for those people. So the need for an investment advisor is more to do with having a disciplined approach in your life rather than giving you advice on where to invest, where to make more returns. There are so many people are, in where you can learn all those things.
Hmm.
But discipline is something which you can't learn on your own.
Right.
So
That's a harder to.
that's the most harder aspect which people don't figure out.
Hmm.
And wealth is a disciplined approach. I mean, there is a famous saying that if you compound your money,
Hmm.
nothing, that's the eighth wonder of the world.
Hmm.
And compounding can only happen if you are disciplined.
Hmm.
It's not about which stock you pick up, which market will go down or up, or whether you take a right call on that market.
Hmm.
That doesn't decide wealth.
It's the consistency.
Consistency and discipline.
Also, coming back to another question, as a young audience, like I'm 22, and I watch a lot of reels and a lot of content on finance. So there's a rise of finance influencers, fin influencers. How do you think that makes a difference than a financial advisor?
So it's a fundamental, I would say, tug of war happening, okay, between the two sets of people or two sets of strategies. I mean, one is DIY, which is do it yourself.
Hmm.
Okay, so when you watch a fin influencer or
Yeah.
when you watch somebody giving an advice just
Right.
over the air, basically you are going to decide for yourself after listening to that person whether
Hmm.
you should invest or not invest.
Yeah.
Okay, you can make a mistake in that journey. You
Hmm.
can make some money out of it also. The issue is it will not result into generation of wealth because you don't have the right temperament or knowledge
Hmm.
to be there in the market for long period of times. So DIY as a concept is very sold, but I'm afraid, it will never result into wealth creation for anyone.
Yeah, it will not tackle the serious problem.
Right. While investment advisory is something where you are appointing an investment advisor for yourself,
Right.
and then you're trusting that person to handhold your investments over a long period of time. So here you are not doing it yourself. Here you are trusting somebody else to manage your money.
Yeah, where the objectives are set and we can meet the goals. So let's talk about something that confuses a lot of people. What is the key difference between mutual fund and us?
So mutual fund and us are not comparable, first of all, because as part of our investment advisory process, we also recommend few of the mutual funds as part of the portfolio.
Right.
Okay. Mutual funds are generally DIY. Lot of people buy it themselves, either through a distributor or through these direct platforms which exist. What we help people is that we help them navigate into this jungle of roughly 2000 odd mutual fund schemes and get them to the right set of funds which are low on expense ratios, which are easy to track, and which can achieve their financial dreams over a long period of time without bothering too much about underperformance, outperformance of the mutual funds. And the reason why we have chosen passive funds and we have not chosen any active funds on our Fydaa investment advisory process, the reason is very simple, that we want to give people market returns. We're not in this game of outperforming or underperforming the markets. We are in the game of achieving the financial dreams of people. And market returns in India have been phenomenal. So there's no point in taking higher risk, especially for the common man who is anyway afraid of market volatility. So to answer your question, mutual funds, we do take advantage of them in our investment process, but we only focus on passive mutual funds on our process.
So there's also a term called passive investing, which as a 22-year-old Gen Z, I would never know. So what would be a process where I can learn about finance or index funds or Nifty 50?
So again, when you ask this question that where I can learn from, see, all of us can learn from by reading. All of us can learn from a lot of other, subject matters which are available. See, passive investing and passive funds. See, passive funds comes out of our habit of passive investing. So what is passive investing? Passive investing is like that you buy and forget. You don't do regular invest. You don't track your money regularly whether the market goes up or down.
Yeah.
And you are passively, your money is getting deployed month on month. That's like a regular SIP which you do.
Right.
Okay. That's called passive investing.
Passive investing.
Active investing is when you are regularly investing. You're regularly looking for ideas to invest. You keep listening to a lot of influencers. You keep listening to a lot of commentators. And you keep churning your portfolio. Okay. So that's called active. Now, we focus on passive funds.
Passive funds.
Why passive funds? For the simple reasons that they want to give market returns. We don't, as I mentioned, we are not into the business of outperformance and underperforming the market. Secondly, the expense ratio are very low. I mean, we save roughly 1 to 2% of our clients' money every year, and which can be, if you compound it over a long period of time, can be a very big chunk of the returns. We save that kind of money. I mean, for example, just to give you an example, if you're doing a 15,000 rupees SIP, okay, for next 30 years, and if the market average returns of the market, assuming they give 15%, your corpus should be around 10 CR at the end of 30 years. Okay, but because you've invested in active funds, you essentially get around 7 CR.
Okay.
So basically, in over a period of 30 years, you don't realize that you paid 3 crores worth of
SIP
fees to the mutual fund, active in fund managers. That's the difference between passive and invest. So passive, your expense ratios are less than 0.2%. And even with you, if as an advisor, if you see our nominal fees, they will never match up to the kind of fees which, the hidden fees which you pay. So very important that even if you want to invest yourself into passive funds, do it yourself rather than going and trying to pick up active funds.
Okay.
because you would never know what performing today, what is outperforming today may not outperform for the next cycle.
Investing, as we know, that it's important, but why does having a plan make a big role? Why does having a financial advisor make a big difference than just investing?
Okay, so it's like when somebody is planning, it's like when you invest without any purpose in your mind,
Yep.
you are not clear what is your end objective. So you would never be able to go far with it. When you know that, why do we, so for example, most of us would have a health insurance. Why we have a health insurance? Because there is an objective to achieve, which is to take care of our health in the unforeseen circumstances.
Right.
So, but when you invest or you do an SIP, you don't have an objective. And that's where the role of a financial planning comes. What happens in a financial planning, that generally all your incomes and expenses, all your assets and liabilities will be analyzed by the planner. They will be able to guide you to fix what are your priorities, financial priorities. They will be then able to guide you how much money you need to set aside to achieve every financial priority you have in your life. And then they will also be there navigating with you during ups and downs of the markets to help you achieve your financial dreams.
Okay.
So the without planning, if you just go haywire, it's like moving in a jungle with no direction.
Yeah.
But with the financial planning, you would be exactly knowing where you are heading. So you will be always staying invested to achieve that goal or purpose.
Yeah, that will also make me consistent with my efforts. If I'm just investing, I'm just not thinking about it at all. Also, there's one article that spoke a lot about financial literacy in India, and there's the percentage is consistently really less. So, what would be your take on this, being a CEO and a founder of a finance brand?
So see, financial literacy is two-way. One is to understand whether you need to invest. Other is, a lot of people confuse the literacy part with trying the DIY thing, which is let me understand how to invest. One is to know that you need to invest, you need to save money. Till that level, the literacy is required. But the moment people get into doing it themselves, that I would be able to pick stocks for myself, I will be able to pick mutual funds for myself. When the literacy goes to that extent, then it becomes a big problem. That's where most of the frictions I would see in the current ecosystem exist, where people are in the name of literacy or financial literacy, they are teaching everybody to become a fund manager, which is not possible.
That's
right.
Yeah.
So I think the financial literacy is required for people to understand the need for channelizing their money into the right. They should not just be putting their money into gold or real estate, which is predominantly in India people are doing.
Yeah.
And to that extent, people should know then that there is the whole market exists for them to participate. It's just that they don't know how to navigate it. And that's where the role of a professional come into picture. They should be able to appoint a professional for themselves who can generate returns which are more than inflation for
Right.
them to generate.
I was coming back to the same thing. You said like in an Indian system. So in an Indian household, investing is all about doing an FD or getting gold or real estate. How do you bring a picture of, let's say, investing to them? How do you make them aware about this?
So it's very simple. I mean, we have been doing this on the field also, this thing. We generally most of our field people will carry a calculator. And then they will show to them that most of the people whom we talk, we first understand their problem, where they are channelizing their money.
Right.
And predominantly the answer comes is that the money is in the bank account, or the money is into RDFD, or the money is into some gold or real estate.
Yeah.
Then we give them a calculation that this is your the average return which you are getting is around 6 to 7% in most of the instruments. If you and then we also show them the mirror that the inflation is around 10%. So then we tell them that, boss, your money is going negative over a long period of time.
Right.
You are not making money with that 6%. And this has acted as as an eye opener for a lot of people. A lot of people are not able to calculate in their mind this inflation
Right.
aspect. They think the money is growing, but in real sense, the money is going negative.
Okay.
And that's how we then show them the picture that how participating in financial markets with the help of a professional can help them achieve inflation beating returns
Right.
without taking correspondingly very high risk.
Okay.
So if you're able to get this point across in the minds of people, I think that will change the game.
So coming back to the brand, if I am actually very influenced by you right now, so if I as an individual, if I want to start investing today, what is that one thing that I need to keep in my mind, and what is that one thing that I need to ignore, like, completely?
I think everybody needs to have a financial plan. You should ask yourself a question whether you're a 20-year-old or whether you're a 35-year-old. Do you have a financial plan? If you don't have a financial plan, then I'm afraid you will be just wandering here and there with your investments with no concrete results to
Yeah,
show at
so no
all.
goals, no.
Yeah. So first thing,
direction.
everybody should have a financial plan. If you are young, your financial plan will look different. If you are in middle age, the financial plan will look different because the financial priorities are different. But the advantage of starting early, most of the young people today don't realize that the time is on their side. Most of them think when I talk to them, sir, अभी बहुत time है. अभी तो start किया है. We'll see investments when we become 30-year-old. Then I'll tell them, boss, by the time you become 30, 35, then you miss the bus of time on your side.
Right.
And so this is also a very tough sell we have to do to a lot of youngsters. But I'm the way we are going, I'm glad that a lot of people are now with education and all are learning the importance of compounding. I mean, the number speaks for itself. When you start an SIP at 22 versus you start an SIP at 30, your SIP amount goes up by 3 times for the same set of goal amount.
So for a college student who wants to, let's say that person's getting a stipend, what would be that 1% of, like this percentage you have to keep aside for investing? What would be your take on that? Like anything, advice?
Generally for the college going kids, we generally are not asking them to set aside their money, but we would like them to understand
like a discipline
that 20% of whatever you are earning, whether you are a college going or whether you are a regular person, at least 20% of your money should be saved. How you can save, that is also something which the investment advisor can help you. See, I think one interesting aspect here we need to highlight that when we talk about investment advisory, everybody talks about investments. But investment is just one aspect of it. An investment advisor would also help you in budgeting. A lot of people will, when you meet them, they will tell us that, sir, we don't have savings. So the investment advisor can in fact analyze your numbers, can get into your bank details, account details, can understand your incomes and expenses, and can help you first save that 20%. Okay. And then they will probably guide you to invest. Okay. So a lot of time people just come to an investment advisor with a perspective of getting an idea about where to invest rather than how do I save first to invest, because you don't have money. 90% of the people in India, if you ask them, they are just living paycheck to paycheck. They are not able to save money. So if you're not able to save money, how will you invest? And that's where the role of investment advisor comes. Take the help of an investment advisor. They will guide you on saving as well. Investment will be taken care of if you have savings. So I have a very interesting question. It's about how Indian mentality is. In India, marriage is overrated. Like if you have to get married, it has to be lavish. You need to have a lot of gold. There needs to be a lot of guests, and that obviously you'll have to splurge a lot of money for that. So a lot of people are taking loans to get married, which again is debt. So how do you think Fydaa can bridge the gap here? I think it's an interesting question. I think we can't change the societal norms in such a short span of time. But what we can probably help people in planning. So marriages are generally planned well in advance. Yeah. So at Fydaa, in our platform also, we have given options for people to set up their marriage funds. They can plan well in advance with our plans. and can achieve their goal, whatever amount of them need for their marriage, in a very systematic manner. And there will always be an advisor to guide them on achieving that goal. The important aspect here would be that the goal amount, whether the goal amount which the marriage requires is within your means of income.
Right.
I think a lot of people, when they go for loans, they are doing it out of going beyond their means, which we don't recommend. So we will also help them and guide them. Our advisors over there will guide people on what is the optimum amount of money you should spend on your marriage. Okay. So we go to that extent.
Okay.
If somebody wants to spend 50 lakhs with an income of 5 lakhs, we'll be very polite to tell them, boss,
You can't.
that's not possible.
Yeah.
You can maybe have a marriage where you can spend 5 lakhs rupees, and we can help you achieve that also, which is reasonable.
Yeah.
So we also bring down people's hope and show them the real mirror. So these are the things which an advisor can add value in many ways, which you as an individual can't see for yourself.
Yeah, so like as you mentioned, if I need to get started, I need to listen to a financial advisor. But then the trust factor comes in. How do I trust a financial advisor if he's giving me the right kind of advice? Even though he's registered from SEBI, I don't know if it will actually work for me. How do you think I can, like in an Indian household as well, how do you think that can come back?
That's a good question to ask. See, trust is something, it can't be built overnight. Okay. So relationship with the financial advisor is something like any other relationship we have in our life. We start somewhere.
Yeah.
Okay. We start with little piece of advice. We see how that works. Similarly, in case of appointing an investment advisor for yourself, one should clearly see one red line which is registered. So registration is very important. So that filters out at least the non-registered people out of the window.
Right.
Okay. Now, since you are registered, at least I would say because of the stringent guidelines SEBI has, I would say 99% of the ecosystem players are very well robust. And I don't see mis-selling happening because the regulations are so watertight. Now the question comes, which investment advisor to go? One can choose among based on their preferences. But I think starting a relationship is very important with the registered people, and then gradually build trust with them.
Yeah.
Because you can't just build a trust with anybody and everybody on a day one. It's a process.
It's a process. It's a
But
journey.
not appointing an investment advisor with the fear of not having trust is in itself also a very wrong.
That's a wrong approach.
Wrong approach. So take the baby steps and gradually build trust.
Right. Also, during your journey as a financial advisor, I'm sure even you might have had some experience or certain financial blunders or certain stories that you would like to share. What would be the most?
I think typical, which happens with every youngster, not starting early investing.
Achha.
Okay. Not taking things seriously as far as long-term plannings are concerned. So as income grows, I think one typical mistake all of us make, that as income grows, our lifestyle expenses also grows with that. Very few people are able to increase their saving rate with the income. Okay. I've seen people's income rising tenfolds in 10 years time frame. Still, people are broke. The reason is very simple. With the rising income levels, the expenses have also. I think this happens in the young age because the guidance is not there, and people are chasing a lot of short-term dreams at the cost of long-term. What does that mean? That during the young days, we generally try to have everything on EMI with the things which we can't afford.
Yeah.
And that takes away a lot of our saving, these days everybody is on EMIs. So which is both a good and bad things. EMIs per se is not bad as long as you're creating an asset for yourself. But EMIs for consumption is very bad. But a lot of youngsters are into that. So some of these mistakes are common mistakes which every youngsters go through, which result into a lot of future issues like debt trap and all. we have seen a lot of cases come to us as an investment advisor where people are into debt trap, and we help them navigate out of that first.
Okay.
So that's, I think I would suggest everybody not to get into that trap, which generally happens in the young age.
That brings me back to my next question. So we are living in this fast-paced technological era, and everything is moving like pretty fast. With that in mind, how is Fydaa moving across with the technological aspect? Like, how can I start with Fydaa today?
So Fydaa is, as you have seen, I mean, we are a completely digital platform with a human touch.
Right.
Okay, the human touch is in terms of the advisory, the advisory which you get when you getting onboarded with us. See, the while digital, as I mentioned, that without digital, without a tech layer, we would not have been able to serve as many people as we want to. And the whole onboarding process, whole advisory process, everything we have digitized in many ways. Now that makes life easier not only for the user but also for the advisor as well. With the advent of these KYC norms and digital, footprints which are there, the onboarding has become very simple.
Yeah.
I mean, just a few clicks you can get onboarded, and there's no need to file physical forms. So that makes life easier for people to adopt our services. Now, that's the only reason why this particular investment advisory services can be democratized. Without tech, we could not do that.
Think of.
So I think technology is going to play a key role going forward. And but with Fydaa, we have made sure that there's a human aspect of a direct connect with a registered investment advisor, which is, I would say, our key USP. We would never have any user with complete digital experience, with no human touch. Every individual has been marked with one investment advisor, whom they can reach anytime for their financial advisory or consultation.
Okay.
Yeah.
Which brings me back to my next question. As you said, Fydaa has the human touch. Now everything is getting AI. You see, even with ticket bookings and like everything is seamless with AI, and AI can now replace humans very easily. Like now, ChatGPT can give you a lot of financial advices, a lot of investment advices. How do you think this can Fydaa can be a replacement for AI, or is it better than the AI?
So first of all, there's no competition between us and AI. I mean, AI is still evolving. AI is more of a tool rather than a competition. I mean, we would like to use AI
as a
to
tool,
streamline our processes, to make maybe improve our productivity of our systems and processes. AI would never be able to replace the human touch. I mean, AI can do a lot of stuff. They can generate a lot of ideas. They can generate a lot of advice. But there is a certain human touch which, when it comes to money, which is can never be replaced by AI. And I believe that with the right blend of AI and human touch, I think that's the right way to go about it.
So that brings me back to my last question. If there's a 25-year-old person watching this podcast, what would be that one financial advice you would give them in terms of investment, money, wealth, and stuff?
I think one simple thing, I mean, get your financial plan from a registered investment advisor, and then work on it, follow it religiously. And I'm sure 10 years, 15 years down the line, when you will look back, you will see that how far you are from people who didn't have the financial plan. You will be miles away from people of your age.
So thank you so much. And that was really insightful. I mean, even as me, because I'm not really into finance and I have no clue whatsoever, but I think that gave me a lot of motivation to at least start with something rather than nothing. So I'm sure people who are watching this podcast will also have some sort of motivation to at least get started in that first bit. So thank you so much.
Thank you.